All right, welcome everyone to Making Sense of Dollars, a practical guide for managers. Hosted today by our presenter and distinguished guest, Professor Jeffrey Byrd. Professor Byrd is an esteemed faculty member here at LPU, and he's the director of our business program. I'll be reading his bio in just a minute, but I'd love to give some context for our webinar, just so you have a sense of how we'll be moving forward and what we'll be covering. As we move through the content today, which is, I know, going to be incredibly applicable, you will be able to ask questions by typing them in the Q&A. Our Q&A section is the best way to have your question answered. We'll try to get to as many as we can. And speaking with Professor Byrd, the intention is to stop a couple times throughout the presentation to address some of what's in that Q&A section. And of course, you can also drop a note in the chat if you need to. At the end of our presentation, I'll be sharing a bit more about our business program, so please do stick around from that. But we're so glad that you're here. I'm going to pray to get us started, but before I do, I'd just like to share a bit more about Professor Byrd. Professor Byrd is an international motivational speaker, interdenominational teacher and preacher, professional life coach, and if that's not enough, a university professor who's the chair of our business administration program. Pastor Jeff, as he's affectionately called, also served as the associate pastor for Zoe Christian Fellowship in Whittier and executive director of Antioch Missions International. He also served on Pastor Jack Hayford's executive team as the CFO for the Foursquare Church, as well as the chief operating officer for the Union Rescue Mission, and as finance and HR exec for the Walt Disney Company at the happiest place on earth. Additionally, Jeffrey is a former U.S. Army officer completing the ROTC program at the University of Pennsylvania. So we're so fortunate to hear from Professor Byrd, who brings a wealth of experience through decades of just on-the-ground, concrete business expertise and acumen. And he's also a veteran and a pastor. So he brings all these hats to his work. And so we appreciate that he's here to present in this important topic. I'm going to pray for us and let Professor Byrd get started. But again, we're so glad you're here, and we'll have information for follow-up for all of you at the end. So let's pray. Lord Jesus, we thank you for this opportunity for us to come together, to grow in our business insights, to learn from an esteemed expert, and to be able to take these insights back to our communities, our organizations, our institutions. Please bless this time and the conversation. In Jesus' name, amen. Professor Byrd, I'll hand it off to you.
All right. Well, welcome, everyone. It's my honor and privilege to be able to share a little bit today about making sense out of dollars. This is designed for folks that don't have a professional background in finance or accounting, but you need to know how the back office of any organization is doing, how is it running. I kind of make an analogy to running any type of business. Ministry is a business, right? Jesus at 12 told us that he must be about my Father's business. And so no matter what you're calling, understanding the business concepts and financial statements, how to read them, how to make sense of them is going to be key in the success of whatever you're called to do. When you go to one of a new restaurant and you love the food, it's great, you tell everybody about it. And then you go back a few months later to bring some guests along with you, and you find that that restaurant isn't there anymore. Now, it wasn't because they didn't have great food. It wasn't because the service was poor, but somewhere in the back office where the records are being kept and the operational side of the business is happening, maybe someone didn't understand how to read financial statements or how to research variances or over expenses, under expenses, over revenues, and where to best make those adjustments to keep the business going. So today we're going to go through some information. I'm going to hit it high level. There's a lot of information, but I want to extract out kind of the salient points for those of you who might not be financial professionals, that you can understand financial statements and how to make data-driven decisions that will lead your organization to success and significance. Alrighty, so let's go ahead and get started. What we're going to be covering today, if we can go to the next slide, is how do financial statements, what are the basic financial statements that are produced by corporations, and how do the firm stakeholders use the information in the financial statement. We're going to also talk about financial statements and the information that each one of them provides, right? What is the purpose of a balance sheet? What's the purpose of an income statement? What kind of information are we looking to extract from a particular statement, right? And then we're also going to describe and illustrate financial statement analytic methods. How do we analyze these? Next slide, please. We'll take a look at some of those methods of analyzing them. One of the things we'll look at is ratio analysis. And how are those conducted and what do they tell us, and as well as our investors. And then finally, we're going to talk about some potential problems or caveats associated with financial statement analysis and ratio analysis. Next slide. So many of you that if you invest in a company, you are a stockholder, you are a stakeholder, you are an owner. And by virtue of the shares that you own, you are typically in receipt every year of a company annual report. Most companies now in Saving Trees are sending those annual reports online. They usually begin with an opening letter from the chairman discussing the operations, the past year, kind of some projections about where the company's headed. And there is a section that includes the financial statements. In all publicly traded companies, they're required to have the four basic financial statements, and you see them listed here: a balance sheet, income statement, statement of retained earnings, and statement of cash flows. Next slide. So when we're taking a look at financial statements and how is the company performing, that's really what we're taking a look at, right? And what is their prospects for future performance? All right, so there's a couple of ways that we analyze that. One is using analytic methods that we'll talk about that examines how things are moving. What's the trend? What's the percentage increase in revenues? What is the percentage decrease in expenses? And how does that look across time? The other analytic tool are ratios, which are generally information that you pull off of the financial statements, right? And it's akin to going to the doctor's office. And when you go, you get put on a scale. They tell you how tall you are. They tell you how much you weigh. They take your temperature, blood pressure. And so you're getting statistics, you're getting data that falls in line with an acceptable range. Well, you can do the same thing with financial statements. Next slide, please. So both of these analytic methods, whether it's taking a look at how are we doing against ourselves over a period of time, right? You can compare an item or a ratio from a prior period and tell whether or not we're improving, whether we're staying the same, or whether we're slipping backwards and need to focus some attention in a particular area, right? So we really want to take a look at the financial condition. What is the liquidity? We'll talk about what exactly that means in a little bit. What's the solvent? Are we solvent? Are we going to be in business? Are we in trouble of not being a going concern? And profitability, right? I tell my students all the time that if you're in business, right, and you're not making dollars, it's not making sense, right? So if you're not profitable, you don't really have a business. What you have is a, right? Because what are we doing? We're paying to do something. That's what a hobby is. But a business is supposed to be profitable and ability to take care of a lot of people, primarily your investors and your shareholders, but you're also employing people who are taking care of their families. And as believers, we're also advancing the kingdom through operating in our business gifts. So one of the other analytic tools is to compare our numbers against other companies, right? Within the same industry, that can provide some very insightful information about how we're performing relative to everyone else. Yes, that'll be fine. Next slide. So the value of financial information, right? A lot of people use them, people that are running the company, people that are looking to invest in the company, people you're looking to loan money from, your employees, so they can see how stable the company is. And usually financial information is being evaluated along three lines. And we talked about liquidity, solvency, and profitability. Next slide. And so liquidity is basically what is the company's ability to convert assets into cash? How liquid are you? Short-term creditors, banks, financial institutions, they're primarily concerned with, are you able to pay back what bills you have outstanding in the short run, such as your loans and your notes? Next slide. Solvency. Long-term creditors, those that hold your mortgages and bond holders, they're interested in evaluating your ability to make periodic interest payments on top of paying back your principal. So are you solvent? Are you able to take care of your long-term debts as they come due? That's basically what solvency has to do with. Next, we talk about profitability. Are you earning a profit at the end of the day? And even if you are a nonprofit organization, right, that's kind of a misnomer, right? It has to do with the purpose that you're in business. Nonprofit organizations, particularly 501c3s, hospitals, universities, exist for the public interest, right? That doesn't mean that they're not profitable. When I say profitable, that their revenues exceed their expenses, because when that happens, you're able to stash away money in reserves so that as business cycles go up and down, you're able to weather the storms of uncertainty. And you're able to maximize opportunities as they become available to grow, to expand, and to do more with what you have. Next slide. So we're not going to go into this in detail, but just to let you know that behind the scenes, there is a cycle, an accounting cycle, right? Chris, is there any way to just maximize this page a little bit, to tap and maybe Command Plus and make it a little bit larger? Wonderful, wonderful. Back out just a little bit, please. Perfect. All right, so we see what happens is that there's business transactions happening every day. We're buying something, we're selling something, we're expanding, we're doing transactions. So we analyze those transactions through our accounting system. You may hear or have heard that there is something called an accounting equation that underpins all of the basic structure of how we account for transactions, how we flow those transactions into financial statements. The basic accounting equation is assets equals liabilities plus owner's equity. So we're going to get into each one of those a little bit so you can understand what is an asset, what is a liability, and what is owner's equity, right? So after those business transactions, you go through debits and credits. We're not going to get into those details. You've got an accounting department or someone who's doing your books for you. But the basic takeaway here is that in accounting, we have a dual entry system where debits have to equal credits and everything has to be in balance after we record a business transaction as it relates to our accounting equation, assets equals liabilities plus owner's equity. Next slide. All right. So most companies have what's called a chart of accounts. This is a fictitious example where you have all of the accounts of the company, and there's a number that's assigned to each account. You got cash, accounts receivable. You can see kind of the list that goes down to some liabilities with your accounts payables, account 22, salaries payable, coming over to account 30, 31, 32, which are your capital or owner's equity accounts. And then 41 is your fees earned or your sales. It's a revenue. It's the money that's coming into your business, and then followed by the expenses or the bills that you have to pay. Next slide. So can we make this a little bit bigger, Chris? All right, perfect. So what we're going to do here is basically talk about how the financial statements feed each other. On the top left, if you have a pointer and you can point to that spreadsheet on the top left, we see those accounts that we saw in the chart of accounts listed there, and then their balances, their ending balances. We transfer those over to our balance sheet on the right, right? So all of the accounts that are in blue are balance sheet accounts from our worksheet. And then if we go down, scroll up a little bit, all the accounts that are in that yellowish color get transferred onto our income statement, right? And then the bottom line net income from our income statement goes to a couple of different other statements. The bottom line net income is used in our statement of owner's equity, right? And it's also used up in our balance sheet. If you see the arrow going from net income, it adds to our owner's equity. All right, so let's talk about assets, liabilities, and owner's equity and kind of what they mean. An asset is something that the company has in their possession. They have use of assets to make money, right? A building, supplies, equipment, land, so to speak. Liabilities are the portion of those assets that are owned by somebody else because you have a mortgage, you have a bill to pay. And the equity, owner's equity, is the difference between the asset and what you owe on it. Just think of it sort of as your house, right? How much equity do you have in your home? Well, basically, it's the value of that house minus what you owe the bank is your equity in the house. So you can think of owner's equity in that same manner. Next slide, please. All right, so the balance sheet. What is a balance sheet? We see how it was prepared from that adjusted trial balance worksheet. But basically, a balance sheet is a snapshot in time. It is, what do I look like today? And if I were to compare it to streaming services, right? We consume media in many vast different ways than we used to when we were growing up, right? So you have still photos. You can think of a balance sheet sort of like a still photo. And an income statement, however, is more like a streaming video because the time period that an income statement covers is a month or a quarter or a year. So what is my activity over a period of time? Sort of it's streaming, if you will. Whereas a balance sheet is as of 12/31/2000 XX or June 30th. It's just, what do I look like at this point in time? So the balance sheet is where you're going to find your assets, which are generally divided into current and non-current. Same thing with liabilities, current and non-current. Current are those things that are due and payable within 1 year. Anything longer than that is non-current. Next page, please. So here's a sample balance sheet where you see it's divided up into current assets cash, accounts receivable, supplies, prepaid insurance, and long-term assets, your property, plant, and equipment, your land, minus the depreciation. So you add that together to come up with your total assets we see over there of 29,000 some odd dollars. Now that has to equal, if you remember our accounting equation, assets equals liabilities plus owner's equity. So we have our current liabilities. In this case, we don't have any long-term ones. This is just illustrated purposes. And so the current assets we see are $1,390,000. And the owner's equity, the capital, our share of ownership in the assets is 2911. So the total liabilities and owner's equity of 29,495 equals the total assets above 29,495. So the balance sheet is in balance, right? And so that number down at the bottom, we get that from the statement of owner's equity. So in between these financial statements. Next. This is another sample balance sheet from a different company. And one of the things I wanted to point out here is that normally when you see financial statements in an annual report or something that the company publishes, they are always comparative. You have at least 1 year to compare against the current year. In this case, the current year is shown as 2014. You see last year, so the amounts you're able to see the percentages of assets that represents. So here in 2014, we have $845 million in assets, and cash is $15 million, which represents 1.8% of our total assets. So that is what the percent of assets shows you. And then you can compare that to a prior year to see if you are gaining assets as a percentage of your total or losing assets as a percentage of your total. And you have a percentage for every line on the balance sheet: assets, the accounts payable, the liabilities, and the equity. At the end, there's some informational data there where you show the book value per share and the market value per share as of this closing date. As you see at the very top of this page in blue, December 31st is the date of this particular balance sheet for 2014, and that's compared to 1 year prior, December 31st, 2013. All right, a snapshot as of a point in time. Next page. All right, so current assets we talked about, and these are some examples of current assets, right? Within 1 year or less, you can convert them to cash. Next. These are explanations of the various types of current assets. Notes receivable. Next page. Then you have long-term assets or fixed assets. That includes land and assets that depreciate over a longer period of time. Next. Same thing with current liabilities. These are amounts that you owe to creditors that are going to be due and payable in usually 1 year or less. And you have various types of creditors, whether they be accounts payable for your supplies, notes payables for agreements that you might have, wages payable for that last week of earnings, for salaries for employees that have worked but yet haven't yet been paid, and so on and so forth. Next, we have long-term liabilities. Okay, next, we're going to go to our owner's equity. And once again, our equity is what is our right, what portion of the assets do we own outright? And you add that to the total liabilities. And when you add those together, they're going to equal your assets. Once again, the accounting equation is in balance and it's presented on the balance sheet under the liability section. Next page. All right. So there's different ways that you can present a balance sheet. Classified is what we have gone over, and that is the most common. Next sheet. We're going to skip these, next one, in the interest of time, and move straight to the income statement. It's prepared directly from that worksheet that we started off with, and it shows your revenues minus your expenses. Next. Here's a sample, right? And you have some revenue from fees earned. Then you have some rent revenue to come up with total revenue of $16,960. And from that, you subtract out your operating expenses. Now, notice the title of this income statement. It is for Net Solutions income statement for the 2 months ending December 31st, 2018. So this is not a snapshot as of December 31st. This is what was the video, what was the stream that took place over the last 2 months, November and December, what type of activity took place. So we see that our total expenses, $9,855 subtracted from our revenues, leave us a total net income of $7,105. And we transfer that figure over to our statement of owner's equity because we own that money outright. We earned it, and so it should cause our equity in the business to increase. Next slide, please. Once again, here is a comparative income statement, and that's generally what we're going to see is all of our revenues and expenses compared from this year to last year. Now, our percent column here on the income statement, everything is presented as a percentage of sales. So our net sales is always going to be 100%, right? But then as we take a look at our different expenses, how much of our sales are these expenses representing? Here we see that one of our biggest of sales is variable operating costs at 82%. And it seems as though that was maintained from last year to this year. But you can look in some of your other expenses to see how it compared from last year to this year. Are we going up as a percent to sales? Are we going down as a percent to sales? Underneath of our net income line, we see in 2014, our net income is $54 million. And then we have some additional information that income statements usually contain. Our preferred dividends, our earnings available to common stockholder, which is basically your net income that's available. You might not distribute that all, but in this case, we see that we have common dividends we distributed of $29,000, right? So what are we going to add to our retained earnings is $25,000 because we made 54, we issued dividends to our shareholders of 29 million, and now that leaves us 25 million to put in reserves. That's what retained earnings basically is reserves for the future. All right, and then you have some information about your per share data. What are your earnings per share? What's your net income, the 54 million divided by the number of shares you have outstanding, 25 million shares. That comes to $2.16 or 16 cents. And then what is your dividend per share? So we paid out dividends of 29 million over the 25 million outstanding shares, and that equated to $1.16. If you owned a share, you got $1.16. If you own 1,000 shares, you got $1,160, so on and so forth. Next statement, please. Statement of owner's equity. All right, the first item that you're going to see is the balance of the owner's capital account at the beginning of the period. Then any investments into the business, this is like for a sole proprietorship where the owner is putting money into the business, you would list that here on your owner's equity. Because if you're putting money into the business and you're the owner, that's your equity. You own all of that money. Next. So this is a sample owner's equity statement. It starts with the capital account. Then you add how much did the owner invest, how much net income came in for the year, how much did that owner withdraw out of the company, and then that totals to the net increase over that period of time. Once again, the statement of owner's equity is similar to the income statement when we look at the heading as it relates to the time period covered. It is for 2 months. So it's once again like a streaming video. What's the activity over a period of time as opposed to a snapshot as of a point in time? All right. So the balance here at the end of the year is 28,105, and that balance gets put on the balance sheet. So that's the interrelation between the financial statements. Next page, please. This was an example exercise that is available if we share these slides, but in the interest of time, we won't go through that today. So we can move on to the next page. And the final statement is cash flows, statement of cash flows. Accounting is a little funny in that the profession has standards, financial accounting standards, that dictate how you have to report your financial statement. Specifically, income statement has to be presented on an accrual basis. Now, most small companies that don't have either accountants or they don't have a lot of activity report generally on the cash basis. When money comes in, they recognize it as revenue. When money, actual cash, goes out, they recognize it as an expense. Accounting is a little bit different. In order to recognize revenue, all you have to do is have completed the earning process. So what does that look like for a business? I sold some goods, or I provided a service. If you're a plumber, or if you're an attorney, I provided the service. Now, typically, what do? You send that client a bill, right? And some period of time, maybe within the next 30 days, they will pay that bill and you'll receive the cash. Now, accounting says that you don't wait until you receive the cash to recognize that you earned some money that month, right? So as soon as you completed the earning process, you sold the good, you performed the service, then you must record that revenue in your income statement. And so what do we do with the cash? Well, we set up a separate account called an accounts receivable that says someone owes you some money, and you track that on your balance sheet. But you've already accounted for the revenue on your income statement. All right. So the statement of cash flows is going to take out any of the non-cash items that you had to accrue for and just deal straight with cash inflows and cash outflows for the period. All right. And so what are we looking at for a cash flow statement to tell us? It's how much cash are we generating from our operations, and how are we maintaining and expanding our ability to operate? How are we positioned to meet our financial obligations, and what, if any, dividends have we paid? Next page. We can skip this page. So the statement of financial, the cash flow statement, is really divided into 3 sections. What are your cash flows from operating activities, which is the main reason you're in business, is to operate and generate a profit? Next, what are your cash flows from investing activities, transactions that impact your non-current assets, investing in plant, property, equipment, building new locations, right? How much cash are you investing, or how much cash did you receive if you sold a piece of property? That's not your main business. Your main business is selling goods and services. But from time to time, you have to sell a store, close a store. And so where do you report the cash from that activity? Here in section 2, cash flows from investing activities. And finally, number 3 is cash flows from financing activities. So that affects the debt, the liabilities of the company. Are you borrowing money? That's going to be an increase in cash, but you are going to have to pay that back. So we don't want to generate cash primarily through borrowing money. We want to generate cash primarily through operating activities of the business. Next page. So this is kind of the format, if you will. You have cash flow from operating activities, from investing, cash flows from financing, and then that's either going to be a net increase or decrease in cash for the period, right? And so that net increase or decrease should match your balance sheet in the cash account. So you started with a balance at the beginning, then you had that increase or decrease, and that now when you take a look at how much cash do I have on the balance sheet at the end of the period, this should all reconcile together. Next page, please. So on the statement of cash flows, it used to be called the statement of sources and uses. So you can see here some of the things that would cause cash to inflow and cash to outflow in those three sections. Operating inflows are going to be primarily from the sale of products and services. Operating outflows are going to be primarily from purchasing inventory, paying your employees, and other operating expenses. In the middle section there, cash inflows from investing is if you sell any property, plant, or equipment, or sell any investments, you get cash inflows. Conversely, cash outflows from investing is if you're going to buy a piece of property or plant or equipment, or you're going to purchase some investments, you'll have to outlay cash. And finally, cash inflows from financing is issuing long-term liabilities or debt. You issue a bond, you receive some cash, but now you have to pay it back, right? You issue stock, right? Issue more shares to get more owners, more stockholders. They buy a share, you get the cash, but you've given up some control because now you have more bosses, more owners. And lastly, cash outflows from financing. An outflow would be you paying back those stockholders in the form of dividends, or you repurchasing some of your stock, which is called treasury stock, basically, when a company buys their own stock back. And then finally, another cash outflow would be paying down debt. So you're using cash to pay down bills that you owe. All right, next page. Different companies operate on different year ends. Most companies operate on a calendar year end, but there are other companies that use a fiscal year end that does not match the calendar year end. And so basically it depends on how does your business cycle flow. So for universities, typically at the end of June when classes are over, that's pretty much the end of the year. And so their new year would start July 1 and go through June. That would be their fiscal year end because the lowest point in the annual operating cycle had been reached in the month of June. Next slide. Financial history. So we go from fiscal year end to fiscal year end, and that's our income statement. At any point in time, we can take a snapshot at the end to see what our balance sheet looks like. Next. So the last section that we're going to review is now that we see what all the financial statements are, we know how to read them, what they're telling us. Now, how do we interpret that and extract out data that informs us, are we doing well? Where do we need to focus some more attention? So as we take a look at financial ratio analysis, basically liquidity and solvency are two of the main things that internal stakeholders as well as external stakeholders are looking for. So we talked about liquidity. How are you able to convert your assets into cash? and solvency, how are you able to pay your debts? All right, next. So you can come up with different calculations based on information from your financial statements. One of the most common measures of liquidity is working capital, which is your current assets minus your current liabilities. That should be a positive number. That means I have more current assets than I do current bills that are going out, so I'm in a net positive position. Next. So this was an example from using the numbers. We see that Net Solutions had current assets that were greater than their current liabilities, so they are able to pay their bills, their short-term bills, as they're coming due. Next. Current ratio is taking the assets, dividing them by the liabilities, and you should come up with a number that's greater than 1. Anything less than 1 means that your fraction is upside down. You have more, the denominator is bigger than your numerator, meaning you have more liabilities coming due than assets to pay for them. Having a current ratio that's less than 1 is not good. Next. So here we see Net Solutions. They're looking pretty good just if we look at the number in isolation, but that doesn't necessarily mean that they're doing great, because as we're going to see, current ratios need something to compare themselves to. And typically what we're going to do, depending on what industry we're in, there are sources that provide you these ratios for a given industry, so you can compare yourself to other companies in your industry to see, am I better? Am I the same? Am I worse off than other companies? Next. So overall, there's 5 major categories of ratios. You have liquidity, right? Or can you pay your bills? Asset management, how effectively are you returning on your investment, right? Debt management, do you have the right mix of debt and equity? Profitability, how do you combine, it's combining liquidity, asset, and debt management to affect your profits. Are you profitable? And then finally, market values, your stock price. What does the market think about your prospects? All right, next slide. We talked about some of these already, but some potential problems and limitations of financial statement analysis is that sometimes it's difficult to compare your numbers against other companies in the same industry, because so many companies operate in multiple industries, right? I used to work for Disney, right? And so if we compare Disney to, let's say, Magic Mountain, it's kind of difficult because Disney not only operates theme parks, but they operate Disney stores, retail. They operate film and TV. So there's multiple industries. So is it really apples to apples, right? So that's one problem that needs to be overcome. Inflation can sometimes distort balance sheets. And then we have seasonal factors that, depending on when one company is getting most of its activity, comparing maybe to another company that has a different seasonality impact because they're in different locations across the country, that could present a problem in comparing your results with someone else's. And finally, what we call window dressing can make ratios better, and that is basically management decisions to accrue for revenue earlier in one period so that sales are increased, but really they could be pushed back into another period, but that would make your revenues look lower. So you can, quote unquote, play with the numbers within the prescribed accounting rules. There's a number of different ways how you can report something. And depending on how you want to make your financial statements look, that could be an issue in comparing one company to another. Next, I think that kind of Does it? I know we were supposed to take a break in between, but I think I was on a roll, and we did leave enough time for Q&A. So I'm going to go back to Chris and see who had questions and if we can clear up anything for anyone.
Thank you, Professor Byrd. That was just really impressive how much you were able to cover and go over in detail in such a short time. If you do have a question, to those of you in the audience, you can just type it in the Q&A. You'll find that at the bottom of your Zoom screen where it says Q&A. If you just click there, you'll be able to type in a question that we can present to Professor Byrd. I have seen a few people ask about the slides. Everyone who has attended today will receive both a recording of this presentation and the slide deck. So you will all receive this shortly after the presentation, after we've had a chance to download and edit the video and put together the slide deck for you. So look for that in your inbox in the coming days. But now I'm opening it up to any questions. If you have a question, just type it in the Q&A. And I'm happy to pose that to Professor Byrd. Just to kind of get things started, Professor Byrd, when you're guiding managers through kind of these financial statements for the first time, are there some misconceptions? Are there mistakes that first-time users make where they have maybe the wrong idea of what they should be aiming for when they're doing this type of careful calculation?
Yes, there is probably one of the most common misconceptions, if you will, when folks are taking a look at income statements, is that the bottom line profit, if you will, net income, is what cash went up by in my bank account, right? So they're equating the accounting net income to cash. And that is very far from what is actually going on. And that's primarily because of accounting rules that require you to adhere when you book a revenue item, when you book an expense item. And sometimes it aligns with a cash basis, and other times it doesn't, right? Because for accounting purposes, revenues are to be booked when they're earned, and expenses are to be booked when they're incurred. So you could actually use an item, let's say payroll, and you have employees. Well, an employee generally doesn't get paid the same week that they're working. There's usually a lag, right? Especially hourly employees. So if an hourly employee started working today, they might not get paid for 2 weeks until they get processed through payroll. But at the end of the month, they've actually worked 4 weeks, right? But you've only paid them for 2. But on your income statement, since they actually worked for 4 weeks, you're going to show an expense for 4 weeks because you actually used that person's time for 4 weeks, even though you paid them cash for 2 weeks. So that's where some of the biggest misconceptions, and that you have to walk leaders through to let them understand that the income statement is not necessarily going to line up with your cash in and cash out.
It's really helpful. Thank you. We have one more question. One of our attendees asked, how do you compare your profitability with other companies when you have a small business and the other companies like yours don't make their income public or their profitability public? How do you get that information so you can compare your profitability with others?
That's a very excellent question, because that's the same kind of issue that you might have with larger companies that are not publicly traded, right? Because private companies don't have to necessarily, they don't have the same publication requirements with the SEC that publicly traded companies do. So in that case, what you would do is there's a lot of information that we have available now on the internet. And you can basically search for information that may have been out there, because many companies participate in different types of surveys, right? Not be revealing their full, complete financial picture or statements, but they may have a payroll survey where, in order to get information about salary ranges, they have to input um, information about their pay ranges for their employees. And so there's very good aggregators out there where you, and especially AI now, where you can put a prompt in that says to go search out these different databases and come up with some estimates of what companies in this industry at the same size that you are, what might their percent to sales ratios be for their different expense lines. So that's one way that you can do that.
That's so helpful. That's the last of our questions in the Q&A, and I just want to thank you again, Professor Byrd. We've already had a few comments in the chat, just thanking you for such an excellent presentation and for how helpful it was for those of us who are joining us. Before we leave today, just with the last few minutes that we have, as I mentioned, Professor Byrd directs our business programs and our Masters of Business Administration. And what we like to make available is if you're someone who, as you were in this presentation, you felt convicted, I need to increase my ability to operate in this aspect of leadership for my organization, realizing that it's in these practical aspects that you're able to ensure the longevity and the success. I loved the metaphor, the example that Professor Byrd used of going to a restaurant that you love and then coming back later to find out that because of poor business practice, it was unable to continue. I mean, that extends to many of the organizations that we lead and we work in. These practices are essential. And if you're feeling that you need more training and more education, our Master of Business Administration is a fantastic program. In 18 months and for less than $20,000, you can receive mastery in these types of individual expertise areas to help ensure that your institution, your organization is running effectively, efficiently, and is bringing in the necessary funds to continue to operate. If you're interested in this program, you can scan this QR code on the screen or request information or email me at cwhite@lifepacific.edu. I'd love to talk to you more about getting into the program. I've heard from so many students that it is giving them real practical skills that are immediately applicable in their leadership and their organization. So if you felt that conviction as you were in this presentation that this is just the beginning, that there's more for you that you need to consider, our 18-month MBA program is fantastic and an efficient and effective way to get that expertise so that you can lead your organization better as you move forward. And you get to have more Professor Byrd, which from your feedback in the chat is something that a lot of you would love to have. So we loved having you. We're so glad that you joined. And we're glad to hear that this was so helpful for so many. As always, if you have further questions, you can feel free to email me at the email address on the screen. And that concludes our presentation of Making Sense of Dollars, a practical guide for managers. We hope you really enjoyed this, that you enjoyed this presentation, and we look forward to seeing you at other Life Pacific webinars. We'll hang tight for just a moment in case there are any last comments on the chat. But for now, enjoy the rest of your day, and thank you for joining us. Thank you all for joining. Great comments from everyone. Hearing there was a great presentation and very helpful. Thank you, Jeff. Thank you, Juliana and Yolanda. We're so glad to hear that it was effective. Thank you, Gloria. Okay, with that, I'm not seeing any additional questions. So Professor Byrd, I'm going to end the presentation. Thank you for your time. I'm really grateful for you walking us through this today.
My pleasure. Have a great rest of your day.
You as well.